Today's topic will be quantitative easing, something which has been a topic now for around 10 years and becomes a big topic again due to the corona lockdown and all the negative impact consequences for global economies, in fact. And today we want to, in fact, shed a light on the effectiveness of quantitative easing. Does it work? Where does it work when it comes to asset price inflation? I think we all agree that current developments and especially equity markets, but also in the housing market, to some extent are driven mainly by quantitative easing. But does it really have a positive effect on the economy, on the global economies, once a central bank decides to go this, let's call it, special path when it comes to the policy? So today's agenda, let's have a look at what we want to dig into here. So first question is, we want to answer what is quantitative easing, and then we want to dig straight away into the effects on yields quantitative easing has. What's the target of quantitative easing? And we want to also take a look back at interest rate decisions and also answer the question, as I already said, does QE work? Does it have the positive effect on the economy as you would expect usually, at least in theory, when looking at buying bonds? What central banks do, try to manipulate yields even lower than they currently are, target special maturities in this case, try to pack interest yield levels. But all in all, it hopefully has a positive effect on the affected economy. Even where if this is not the case, well, then probably it's time to look for another solution. And before we start, that's me. Some words on my person. So my name is Jens. I'm a professional trader. I'm a market analyst. In addition to that, I'm in the financial markets. Let me just think about this for way over 10 years. Oh, well, I say way over 10 because it's close to 20, and that means I'm getting old, but however. Yeah, so I'm located in Berlin in Germany. For any information around my person, feel free to check out an interview you will find in the description box of this video. If you watch this on YouTube, by the way. And by the way, if you like what you're just listening to, then just please leave a thumb up here, and hit the subscribe button for further Trading Spotlight webinars, especially every Monday, Wednesday, and Friday. It's Paul, Marcus, and me who are running these events here together with Admiral Markets. And I'm located in Berlin, Germany, as I already mentioned that. And why is this noteworthy? Because Admiral Markets is not just in the markets for nearly 20 years too. So in fact, here's 18 years of reliability. It's right now, it's already 19. If you check out the website, you will see that there's 1 year in addition to that since we started. And Admiral Markets has offices around the globe, in fact, and is a global financial service provider, especially when it comes to FX and CFD brokerage, and has one office, for example, in Berlin, in Germany. And why is this noteworthy? I really like to say that over and over again, because it's very important when it comes to financial decisions and financial business in general. You just like to talk to someone in your native language. I mean, English for us, it's not a big issue, obviously, and I'd be happy to talk to someone in English, and I'm completely fine with that. I'm doing this for nearly 20 years now, so no big deal for me. But I can fully understand people saying, well, if it comes to financial transactions, if it comes to trading, if it comes to my account, if it comes to questions around the platform and tools, indicators, whatever, I'd really like to talk to someone who speaks my language and my native language. And in this case, you have a very good chance to find someone with Admiral having offices around the globe, with over 20 offices around the globe. One in Germany. Here in Germany, we refer to Admiral where we talk about Admiral as the so-called DAX expert. So with the probably most competitive offering when it comes to DAX trading around the globe. In fact, I have never seen someone offering something similar when it comes to conditions around trading, not just commissions but also trade execution speed and everything. So definitely worth a deeper look. but this is also true for FX trading. So if you're an FX trader, you have also a very, very competitive offering. When looking at Admiral markets, there's plenty of resources where you can test brokers against each other. Average spread, for example, you will see that Admiral is every time on top, or at least among the best of three here. And so definitely worth a look, admiralmarkets.com, for further informations. And what we want to do is now we want to look at the question of today's webinar. So we want to answer the question, what is quantitative easing? And there we start with a short introduction. Quantitative easing is in fact a form, roughly speaking, of unconventional monetary policy. So usually you think about monetary policy and central banks in regards to interest rate decisions. And over the last 10, 15 years, probably 12 years, after the great financial crisis in 2008, you may have wondered, okay, what is next after interest rates were already cut to 0%? And you do this usually to push the economy and try to see a revival here. An economy which is completely seeing a collapse needs cheap liquidity, money, and hopefully this money will be taken then, and hopefully it will revive the economy, if you want. The thing is now, if you cut interest rates to zero and you don't see this positive effect, you need further steps to do that. So especially interest rates, in this case cuts, they affect usually the short-term yields. That's what they affect. But it's probably a longer path you want to follow here. And this is where quantitative easing comes into play, where a central bank then starts to buy bonds. In this case, you can see it here, a central bank buying bonds which have a longer maturity, a long-term security in this case, and they buy it from the open market in order to increase the money supply and encourage lending and investing. So that means that once where you mainly target short-term yields by hiking or cutting interest yields, interest rates, and if this doesn't work anymore and they are close to zero, well, you then start to make long-term lending cheaper, and you buy bonds who have a maturity of, let's say, 10 years, for example, to make sure that people lend money for a longer time span and invest over a longer time span into the economy, or start to demand products which are which potentially have a positive effect on an economy, like loans when it comes to buying, not just building, but also buying a house. And so that's the overall target when it comes to quantitative easing, in fact. And buying these securities adds new money to the economy by expanding the central bank's balance sheet. We will have a look at this. And you will probably have already seen over several social media channels, especially when it comes to Twitter, you probably have seen that the central banks have extended massively their balance sheets over the last months, in fact. So with the Fed, for example, after trying to reduce the balance sheet, that was where she started with what she started with in 2018 at the end, the fourth quarter. Some of you probably recall the high volatility of the fourth quarter of 2018, in fact, and that was due to the fact that the communication, the rhetoric used from the Fed was, we have our balance sheet reduction on autopilot. After they bought aggressively bonds already, that was after the great financial crisis, and after cutting yields didn't work anymore, or cutting interest rates in this case didn't work anymore. And then so they had to massively buy longer term securities, expand their balance sheet. And then after there was a revival of the economy and there was some momentum being seen, they started to reduce their, not just bond buying by tapering it. That was over 2015, a big topic, in fact, but or 2014, 2015. but then they also started to increase interest yields and started to try to reduce the balance sheet again. The only problem with that is that market participants saw some kind of taking away the Fed put. So the Fed is seen in the US, in this case, is seen as the lender of last resort, not only, but also it's seen as the white knight, which comes into the market once volatility is spiking higher and equities are sold. Respectively, there's risk of hitting the markets. So usually you expect the Fed then to step up, to buy bonds, or to at least stabilize the market, deliver liquidity. And after the Fed announced that their balance sheet reduction is on autopilot, it meant nothing more than they are willing to take away the liquidity, which is so important for in this case equity markets, but also the bond market, and this resulted in massive volatility. And that was already before the Corona lockdown hit and the US entered a recession in this case. And so that's where the problem comes into play, because if you start with this, the only problem you have is where do you stop, respectively, how can you reverse this this process again. But before we look into this, we want to look at the last point here. When short-term interest rates are either at or drop below zero, that's what I already mentioned, in fact. So how can interest rates drop below zero? Look at European yields, for example. In Europe, you have so much skepticism when it comes to the economy, that and not just that the skepticism that it's not only that the people do not want to lend money or respectively borrow money in this case from which they get at nearly 0%, nearly 0%, but it's also that even if you say, hey, here you have 10,000 euros, let's say, they are not taking the money to buy goods, respectively to start consuming and to see which will then naturally result in a positive effect on the overall economy, European economy in this case. But in this case, the European Central Bank, the ECB, had to buy bonds and still is doing so, and thus pushing yields into negative territory. So that means you're saying, I borrow 10,000 and I just repay, simply speaking, roughly speaking, 99,000. So you're making me a present of 1,000 euros, to put it simply. Again, it's minus 10%. I mean, this is quite a lot. So, but still, you understand what this is about, respectively, how negative yields come into play. That means that the economy is really doing, it's really an ugly state, and you even making money as a present and say, I give you 10,000 and you just pay me back 9,000, does not necessarily mean that people take the money, because they are skeptical of the overall economy. So it's a very unconventional way of monetary policy. It means that yields can turn negative in this case. And so when short-term interest rates, as I already said here, are either at or drop below zero, the normal open market operations targeting interest rates are not longer effective. And then a central bank can target specified amounts of asset purchases. For example, buying bonds of a certain maturity, respectively, for example, saying we buy 10-year bonds, for example, and to try to make sure that our overall target to revive the economy over such and that time span comes into play. So QE and its effect on yields. So what we see here is the ECB balance sheet, where you can, by the way, see this aggressive push higher here. That was due to the Corona lockdown. So far, by the way, we've already seen another milestone being hit. So once I took this screenshot, you can see it here. It's the end of May. It's 29th of May, 2020, and right now we have already extended the balance sheet to over 6,000, which means to over 6 trillion euro. That means that within 1 month, so today is the 3rd of July, so there's only the month of June in between. Within 1 month, they expanded the balance sheet by another 10% and by now 500 billion, which means this is the liquidity which is delivered from the ECB. So they are buying the bonds and delivering. You buy the bond and you deliver the liquidity to the market. Then you pump the volume, or pump up the volume. You pump the liquidity into the market. And the thing is that still there's lots of skepticism if the economy can pick up momentum, at least here in the Eurozone. And this is also true, even you not just see the monetary side, but also from a fiscal stimulus side. You see European governments now sit together, discuss about measures how to revive the economy and say, yes, we are willing to grant 1 trillion euros, which is, even if you don't buy it, which will be bought by the ECB, and then we try to somehow channel this liquidity into the market so that there's enough liquidity to make sure that you don't need to be worried that you're to some extent not getting repaid if you want. And now you can see here in this chart the effect on yields. So I have 10-year German yields in this case, and what you already can see is there's -1 here. So currently, at least here when I took this screenshot, the yield on 10-year bonds. So 10-year bonds is the Bund future is the future market, reference market here in this case. So to yields, it's -0.32%. So that means nothing more than your in this case you're lending, let's say 100 euros, or in this case you are buying 10-year 10-year bond, and then you're getting back 99.68 euros for every 100 euros you're lending. So you're buying the bond for, and this over a period here of 10 years. And this is due to the fact that the ECB is pushing yields lower, and this is the target what they try to achieve. So with aggressively buying bonds in general, European bonds, but especially those of let's call them high quality or of a certain standard. Bunds in this case, so German bunds, they push yields even lower than they already are. So currently you can see that the interest rate level here in Eurozone is at 0, so 0%, but 10-year bonds are obviously trading below that level. And the reason for that is because the ECB, with their quantitative easing, tries to push yields even lower to somehow get demand for all the liquidity which is delivered here. And now let's have a look at interest rate decisions in the past. Okay, so when it comes to interest rates, we made this already a topic over several Trading Spotlight webinars, why interest rates matter and how they affect directly the economy. But just let's have a look here on what we discussed and introduced back then. So when it comes to interest rates, we're talking about the potential yield an investor or buyer of a currency in this case can expect to earn, respectively has to pay if he wants to borrow money, for example, from a bank. So if a central bank decides to increase interest rates during times of, for example, significant economic growth, it should naturally result in higher demand on the local currency in order to get higher returns, and vice versa. So we're in fact looking here at the vice versa part. So which means that if we do not see significant economic growth, but in fact find ourselves in a recession, that means that you have to lower the yields even more and more and lower. And if you do not see any demand picking up here by lowering yields or you lowering interest rates here, rather sooner or later you need to take the next step, which is then buying bonds and try to deliver even more liquidity beyond that point of 0% interest rates. So, and we also introduced the so-called Taylor rule here, which delivers the theoretical idea of fair yield levels. And this is very, very interesting because it perfectly illustrates why quantitative easing is necessary, because they, in case of the ECB, so we are looking here now at the ECB, we also will have a look at the Fed balance sheet and their QE in a few minutes. But first of all, let's have a look here at the ECB. So you can see interest rates here in orange, and Taylor rule, Taylor yield, you can find in black. So Taylor is a theoretical concept which uses, for example, the overall health of an economy. So how is the labor market doing? What about inflation? And he takes all these components here, and based on theoretical formulas, and he gets a value. He gets a fair yield level in this case. And what you can see here is that ends at 2019, but the situation hasn't become better. In fact, now yields, or here in this case, the Taylor yield, will see a significant drop due to the corona lockdown, spiking labor, unemployment in this case, so collapsing labor market. But what we can see here is that even though Taylor suggested higher yields, which came due to solid economic growth numbers, solid purchasing manager indices, which were published, which came through inflation picking up. Whatever reason there was that Taylor took on bullish momentum, here in where at the ECB, they didn't start to hike rates, which would have made sense, in fact, because now in times of a recession, respectively a depression, probably hitting rather sooner or later, you then have the chance to cut interest rates and then take it from there. So if you want, you look at the Fed, for example, they already hiked rates, which they could cut, and in addition to that, then start their quantitative easing, which makes it hopefully a little more effective. The only problem is now with the bad management of the coronavirus in general, and facing the risk of another lockdown, especially, that this advantage, or well, let's call it an advantage, that this will just disappear rather sooner than later. But all in all, we can say, okay, so if we follow Taylor here in this case, as a first suggestion of where we should see yields, in fact, well, then we have some room to play with, depending on the negativeness of the impact in this case corona lockdown has, or the how bad the economic downturn really is. But all in all, we can say, okay, there's still some room we can work with. The only problem now is that they missed that point. I mean, there are reasons for that. You can't really hike rates in the Eurozone, especially when looking at the very sluggish economic growth in, for example, the southern periphery. So Italy, Spain, for example, and their debt levels. You can't really hike rates there. If you do, these economies, respectively states, will just go bankrupt, and then they just do not have an economic model to work with. But the thing is, we now see that there is this economic downturn, and the only way to, let's call it, fight this economic downturn is by lowering yields even further. Only problem with that is that there's no room to lower yields because they are already at zero. And you have seen that it doesn't work in the past. So what else can you do? Well, and this is where quantitative easing comes into play, where you start to try to peg, for example, 10-year yields at a certain level. In Japan, for example, they are also very aggressive in regards to the quantitative easing, and they are pegging, or they're targeting, that's what they use, the word, what they're using, they are targeting a 10-year yield at zero. That means you're lending 10-year money, you're lending out, and you're not getting any yield on this. So that's in fact how it works. And what they try to do is deliver cheap liquidity over a very long period of time to really suggest this to the market and tell the market, okay, don't worry, just take the money and start to consume. And there must be demand for certain goods, in fact. The only problem is if there's no trust in the whole environment, from a political perspective, but also from an economic perspective, the thing is that and as something we can already see right here. So the question which arises is, why should someone do something which he already did in the past and found out that it doesn't work, like they did over the last 10 to 12 years? So quantitative easing is not effective, at least not here in Europe. So probably it is to some extent in the US, but all in all, it's not working. So does quantitative easing work? Obviously, my answer is no. And some economists might probably argue and say, well, at least not yet. So QE has currently inflated asset prices where it was put to work. So what happened with QE, and is currently happening, is that equities are shooting through the roof, that bond markets are shooting through the roof, that real estate prices are shooting through the roof, while it hasn't significantly increased, if at all, demand for loans, consumption, economic growth, respectively pushed inflation expectations higher. And that wasn't even achieved now by implemented negative rates. So the ECB, for example, is forcing banks to increase their lending activities by punishing them once they put money in the bank account with the ECB. And so this is, by the way, the only way they can do that. And this is why it probably won't work that way, because you can't force borrowers to seek loans and invest them. This is something you can't force. You can't force someone to consume, to demand something. So what we're currently seeing is that people are very skeptical. People are scared. They don't know what the future will bring, not just from an economic perspective, but also from a health perspective, because no one really knows if this coronavirus, for example, given the current situation, will be fatal for you or not. So there's fear that you probably won't survive that. And this is not the mental state in which you say, great, there is now, let's say, 10,000 euros they hand out to me, or let's say 1,000 euros. Let's go for the helicopter money approach here. So you're giving away, you print money and you just give it away to the people out there, as they did in the US, for example, roughly speaking. And then they say, hey, come, just buy something, consume, demand whatever you want to buy, just buy it. The thing is that you're not in the mental state of mind to do that. And you really can't force people to change their mind about something. You can start to build trust, but this is now the next problem with politicians who completely lost their credibility over the last years. Just look, for example, what happened over Brexit, for example, and how this whole thing played out so far. So till that day, there's no deal being found, and it has to do with the potential incompetence of politicians, in this case in the UK, but also to some extent in the way politicians here in Europe, for example, are handling the Brexit and the exit of Great Britain from the Eurozone. And given all that, it shows why QE will most likely not work in the future too. So it's not just that it didn't work so far, but it's very likely that it won't work in the future too, but only push here asset prices higher and inflate asset prices higher. So in fact, we could say the longer QE lasts, the more it creates wealth inequalities, punishes savers, and leaves retirement savings at risk. If you don't believe that, or if there's someone who doubts that, I mean, then look at what's currently happening in the US. I mean, these developments there, it's not that that I would say it's only the wealth inequality which was created by the massive quantitative easing which was delivered by the Fed over the last years, the last decade, in fact, and is currently brought on its way. There's certainly other reasons, but I think wealth inequalities, they add to the current revolt, let's call it, which is taking place there. Triggered by these racist what's the word for this? By these racist developments which took place there. Even though, well, if we look at it that way, they have been there for quite a while, and now wealth inequalities probably add to the willingness to change something, and for people to finally go on the streets and try to change something here. And this is a very, very bad development, in fact, which leaves us come to the conclusion, most likely quantitative easing won't work. Here, in this case, I have another chart which is from or which is looking here at the inflation expectations. In this case, not in the US, but in the Eurozone again, and the ECB balance sheet. And what you can see here is the inflation expectation for the next 5 years, which haven't picked up at all, but in fact collapsed completely. When looking here at short-term spikes on the upside here, that was shortly after the great financial crisis. And here from 2000, something like 2011, 2012 onwards, there was a clear tendency on the downside. And currently 5-year inflation expectations are below 1%, despite the fact that the ECB tries everything to create a positive tendency when it comes to inflation. In fact, this these two lines diverge even more aggressive, and it's very unlikely that there will be rather sooner than later that this gap will be closed in one or the other direction. Probably it will be closed, but it will most likely be because of the collapse of the Eurozone, for example, respectively, of the euro as a currency. And this has nothing to do with being a rider of the apocalypse or something like that, but I think it's a real risk we are facing when it comes to quantitative easing, and it's definitely something to take a look at and to keep in mind, and to probably start now to think about ways to escape this downward spiral in which we find ourselves here. In addition to that, you can also see here the developments. So first of all, just to make sure that we are not losing why I show this chart now. So one reason why quantitative easing is implemented is to push inflation expectations higher, so that it's not the case. That's what something you can see clearly here. But also in addition to that, and here comes the next point, it creates wealth inequalities. So here you have this explosion of the Fed balance sheet. This chart is taken on the 5th of June. So it's nearly 1 month from here. By the way, this has already, the white line here exploded on the upside even further with current developments, especially in tech markets. You've probably seen the developments in Amazon. Look at what happened to Tesla, for example, company. I think it's now the 4th quarter in a row. They are showing black. They give out numbers in the black. They're profitable. That's the 4th quarter in a row, and they are now the most valuable car maker in the world with a PE ratio of something like 220 or something, 230 to 1, which is ridiculous. To be honest, I mean they're probably profitable depending on how they calculate their profitability and how they present and give out their balance sheet, and this is not even close to be enough to be the most valuable car maker in the world, and overtaking in this case Toyota, who sold 10 million cars last year. And even the vision, it's not that I'm not fascinated by the vision of Musk in this case, Elon Musk, respectively, the vision of electricity playing such a major role in the future, also when it comes to cars. But still, I'm not really sure whether this is really fundamentally driven, or it's not just a speculative access driven by the massive quantitative easing delivered by the Fed, or at least finding a driver here in the massive quantitative easing delivered by the Fed. And look at this. I mean, Fed balance sheet here exploding on the upside due to the Corona lockdown and all the countermeasures being taken from the Fed, delivering enough US dollar to the global financial system. In this case, we have to remember that the US dollar is still the world reserve currency #1. It has still the status of being #1 here, so there must be enough USD around the globe being delivered. And that's one of the reasons why they have to extend their balance sheet that aggressively. And what happens here is now the S&P 500 PE 12-month forward ratio is exploding on the upside to its highest levels since, respectively, even above the new economy bubble in 2000. That means it's not, when you look at the current developments in equity prices in this case, they explode on the upside while their earnings collapse, because due to the corona lockdown and all the developments around this, you should be really skeptical whether these companies can make even not even close. Well, I think we can all agree, we will all agree on that it's very unlikely that these companies will show or see the same demand depending on what they produce here for their product in the upcoming 12 months, given all the developments around the coronavirus, the fears which I mentioned already, the skepticism of people. You can give them all the money you want. If they are not in the mental state to spend and to consume, well, you won't see consumption picking up in this case, which means that the reason for this explosion here has nothing to do with prices pushing higher aggressively, and following or in lockstep following here the earnings, but it's more like prices explode on the upside due to the massive quantitative easing being delivered, while earnings, on the other hand, and expectations in regards to earnings are collapsing. And this is also a development which in the past, remember what happened 2000, which found itself it wasn't a long year depression, but it was a big bust we faced then, and that was mainly the retail traders. Here in this case, remember or look at retail traders and how they found themselves right here in this environment. So they are taking the money and try to make some easy money. They invest. We call this investing. So buying, for example, shares of companies who fail, who filed for bankruptcy, for example, Hertz. That's a perfect example, I think. And so it's very, very, very similar to what we've seen in 2000, in fact. And this wealth inequality, and they want to have something of this cake themselves. They want to try to accumulate some wealth. I think this won't end very well. And then the big bust is probably something which is a serious and real risk we are facing due to this liquidity access, which is delivered by global central banks, in fact. So let's sum this up then. Quantitative easing, come back to the topic of today's webinar, in this case, is a form of unconventional monetary policy. And with QE, a central bank purchases longer-term securities from the open market in order to increase the money supply and encourage lending and investing. So that's the target of quantitative easing. Buying these securities adds new money to the economy by expanding the central bank's balance sheet. And now the thing is, QE so far hasn't proven successful as of now, and very likely also in the future from an economic perspective, with demand for loans, consumption, respectively economic growth having picked up, or having not picked up significantly, but inflation staying low, while instead inflated asset prices where it was put to work, especially when it comes to equities. And probably this inflation becomes even more inflated, and the prices become even more inflated if the Fed rather sooner or later starts to buy equities. So they do not have the legal permission to do so. They need the permission from the US Congress. But seeing that they're already very active in the ETF segment when it comes to high yield bonds, when it comes to corporate bonds, for example, I think this is just a small step over to equities. Bonds obviously have seen a massive bubble created. It's probably the mother of all bubbles, real estate. So it's very funny. We already here in Germany, we say, and real estate prices are already way above everything we've seen in the past. And then we come to countries like United Kingdom, for example, in London. I have a business partners there. They're laughing at our prices. They're just like, well, your prices over there are cheap. We have inflated asset prices. And so, yeah, given that as something which needs to be kept in mind when it comes to quantitative easing, that inflates asset prices and is not necessarily working on the economy, in fact, and having the positive effects which you hoped to see once you implemented this, in this case, unconventional monetary policy. Next webinar will take place on Monday, which will be the event together with Paul, Trading Spotlight with Paul, trading US tech sector, and he will talk to about what makes up the US tech sector, which has been, by the way, a big topic over the last weeks. I think we all agree on that. Why it's so popular to trade, and should we trade the index or individual stocks? And yeah, Paul will show you how you can trade these tech shares, stocks, which make up this index, respectively the whole sector, in fact, how you can trade them best. And which time? London, 2 p.m. Monday, 6th of July. And if you are now here in the webinar, you will get your registration and link for the webinar in your inbox via email. If you watch this webinar on YouTube, then head over to admiralmarkets.com and to the education/webinar or education tab. There are webinars, and there register under Trading Spotlight. And yeah, so here's the email address, and these are the contact details where you can get further information on Admiral Markets and our webinar series here, Trading Spotlight. This is the risk disclaimer. And that's it from my end. So I wish you all the best. Happy trading. Watch your stops. Talk to you again next week on Friday. I look forward to it. Talk to you soon. See you, and bye-bye.